Assalamualaikum. My name is Azhar Shahira binti Cha Aziz from class JBA 2512C. I'm going to talk about capital asset pricing model and working capital management. We can measure the required rate of return by using the capital asset pricing model KPAM. The capital asset pricing model equates the expected rate of return on the stock to the risk-free rate plus a risk premium for the stock's systematic risk. The risk premium is the difference between the expected return for the market and the risk-free return. The stock systematic risk is measured by the beta coefficient. Therefore, under KPAM, the required rate of return will be expressed as follows. Required rate of return equal to risk minus free rate plus beta in bracket risk premium. Capital asset pricing model (KPAM) can be used by a company to measure the required rate of return. Return can be classified into realized return, required return, and expected return. Required return is the minimum rate of return required by investors to compensate for taking a comparable level of risk. The required rate of return comprises two basic components, which are the risk-free rate of return and a risk premium. The risk-free rate of return is simply the reward for deferring consumption. It is also the required rate of return for riskless investment, such as investment in government securities. The risk premium is the additional return that we can anticipate to receive for assuming risk. Risk premium can be calculated by using the formula of expected market return minus risk-free rate. As the risk increases, we will demand an additional expected return. KPAM theory says that it is only possible to earn higher returns than this of the market as a whole by taking on higher risk, in bracket beta. It provides a useful measure that helps investors determine what return they deserve on an investment in exchange for putting their money at risk on it. The definition of working capital management is a business strategy designed to ensure that the company operates efficiently by monitoring and using its current assets and liabilities to the best effects. The first policies of working capital management is restricted policy. The estimation of current assets for achieving targeted revenue is done aggressively. After deciding, these policies are forcefully implemented in the organization without tolerating any deviations. Adopting this policy will result in an advantage of the lower working capital requirement due to the lower level of current assets. This saves the interest cost to the company and in turn produce higher profitability, which is higher return on investment. On the other hand, there is the disadvantage in the form of high risk due to the very aggressive policy. The second policies of working capital management is relaxed policy. The estimation of current asset for achieving targeted revenue is prepared after careful consideration of uncertain events, such as seasonal fluctuation, a sudden change in level of activities or sales, and so on. The company having relaxed working capital policy assume an advantage of almost no risk or low risk. However, the disadvantage is lower return on investment because higher investment in current assets attract higher interest costs, which in turn reduce profitability. The third policies of working capital management is moderate policy. It assumes characteristics of both restricted policy and relaxed policy. To strike a balance, moderate policy assumes risk, which is lower than restricted policy and higher than conservative policy. The biggest benefit of this policy is that it has reasonable assurance of smooth operation of working operating capital cycle with moderate profitability. The first approaches to working capital management is hedging or matching approach. The hedging approach or self-liquidating approach is a moderate approach that matches assets and liabilities to maturities. Therefore, permanent assets are financed by permanent sources, while temporary assets are financed by temporary sources. In other words, temporary financing, including spontaneous sources, finance only temporary current assets, whereas permanent and spontaneous financing finance permanent current asset and non-current assets. An example will be where an asset, say equipment, that is expected to provide cash flows for over 5 years should be financed by, let's say, a 5-year non-current liability. Another example is, if a firm needs additional inventories for a period of 3 months, it should then use a 3-month credit to finance it. The second approach to working capital management is conservative approach. This approach is referred to as conservative because the firm prefers to have more cash on hand, especially in hard times. Under this approach, the firm uses permanent sources, including spontaneous, to finance all permanent assets, in bracket, both current and non-current, and some temporary assets, in bracket, only current. Temporary sources, including spontaneous, are used to finance some of the temporary assets. This is a very safe working capital financing approach. However, the permanent sources are more expensive. Hence, this approach will lead to lower risk, lower return. Since the firm uses permanent sources to finance some of temporary assets, the firm will have excess cash at off-peak periods. So, instead of having idle cash on hand with no return, the firm should invest the excess cash in marketable securities and earn a return. The third approach to working capital management is aggressive approach. Under this approach, the firm wishes to take high risk. The firm finances all of its temporary assets and some of its permanent current assets and non-current assets with short-term financing, which includes spontaneous sources. The other permanent current assets, non-current assets are financed by permanent sources, which also includes spontaneous sources. Here, the firm is going for higher returns at the risk of possible liquidity problems. This approach could lead the firm to a dangerous position of rising interest rate as well as loan renewal problems. However, short-term debt is cheaper than non-current liability. Hence, this approach will lead to higher risk, higher return. The risk-return trade-off in managing a firm's working capital is related to a trade-off between the firm's liquidity and profitability. A firm can increase its investment in working capital by increasing its investment in current assets. This in turn increases the firm's liquidity. For example, an increase in inventory and cash will make the firm more liquid. It will less likely face a stock out and be able to pay bills on time. However, this may not result in an increase in the firm's return if profit remain unchanged. Therefore, the financial manager has to determine a balance between liquidity and profitability that will contribute positively to the firm's value. Therefore, the financial manager, in considering the risk-return trade-off in general, should only take on additional risk when an additional return is expected. We can now see that the risk-return trade-off involves an increased risk of insolvency versus increased profitability. What will be the effect of increasing a firm's net current assets with no changes in its current liabilities? Liquidity will increase, but reduce profitability. What will be the effect of reducing a firm's net current asset by using more short-term financing and less long-term financing? Profitability will increase, as short-term funds have lower rates of interest than long-term funds over a shorter time period. However, a firm risk of insolvency is increased as short-term funds have to be repaid earlier and more frequently than long-term funds. Thank you.